Hello, this is Dr. Adam J. Bach. In this audio presentation, we'll continue our conversation about finance for entrepreneurial ventures. We've already talked a little bit about internally generated funding, and now we want to talk in more detail about debt and equity. The distinction between debt and equity is extremely important. We described it briefly in the prior presentation. It's a distinction you should understand in a lot more depth. We'll start by talking about debt. The first thing you need to know is that bank financing for a startup is very unlikely without extensive prior operating experience or possibly a personal guarantee. And you might ask, why is that the case? After all, bank loans are a relatively common source for funding for early stage ventures. But there are very specific reasons that banks have challenges in providing unsecured loans to entrepreneurs. So let's take a look at this. Let's assume that a bank has a net interest rate margin of 4%. That is, it's making about 4% back net on the loans that it makes. And it makes 10 loans, and only 9 of them pay back. So this is only a 10% failure rate. If we calculate out the actual annualized return for this particular bank, where it makes 4% on 90% of the deals, but it loses everything on only 10% of the deals, its actual annual return would be negative 6.4%. And no bank can function forever with that kind of return. That means it's basically losing 6 cents on every dollar. And the reality is that the failure rate for startups is much higher than 10%. And so there's no way that banks could consistently make loans to startup companies. But the SBA, in some cases, can provide a loan guarantee through certain types of banks. How does this work? Well, the federal government is basically saying that it will guarantee 85% of each loan. So if the entrepreneur defaults on the loan, the bank is only out 15%, and the federal government picks up the rest of the loss. And so now if we do the calculation, we see that for these kinds of loans, the bank will make 2.1%, which isn't great, but it's often just enough to make it worthwhile. You need to know, however, that SBA loans are not quite as common as perhaps the marketing materials would like to suggest, and only some banks do SBA loans. You can't walk into any bank and just say, write up an SBA loan for me. Either banks do SBA loans or they don't, and you need to find that out, obviously, in advance. Here's the hard truth about bank lending. Banks are looking for 3 things. Number 1, they'd like to see that you already have cash flow. Number 2, they would like to see that you have collateral in case you default on your loan, because then they can collect the collateral and sell it. And number 3, they're hoping to show that you have good character, that perhaps you've done startups in the past or built businesses, and you've demonstrated your professional ability to make money. In the vast majority of cases, a bank is going to require collateral or a personal guarantee from a startup founder if they're willing to make a loan at all. The joke that's often made about banks, and it has some truth to it, is that banks want to lend money to people and organizations that don't need the money. After all, the bank is hoping that you're going to be able to pay this back. And if you don't have money, or your business looks desperate for money, then you are not an attractive target for bank lending. So, if bank lending is not an option, and self-funding and bootstrapping are not going to provide enough resources for you to get your business off the ground, you might then have to look at equity funding. And we're going to just talk briefly about 3 possible sources of equity funding. Friends, family, and fools, that's one category. Angel investors and venture capitalists. So friends and family are very common sources of funding for startup companies, and that kind of funding can be either a loan or equity. If you ask a family member for $5,000 and they write you a check and you don't document anything else about that, the U.S. government treats that as a loan. So unless you specifically provide information showing that they have some ownership, that type of investment is considered to be a loan. This idea that the common investors are friends, family, and fools is a real phrase. It's not something I made up, and there's an article that talks a little bit more about it. And the reality is because if we think is that these are folks who are willing to make an investment, probably based not on logic or rational analysis, but either based on the fact that they know you and like you, or because they're simply not making particularly good decisions. And that's why these three tend to be lumped together. The bad news is that when many first-time entrepreneurs find themselves unable to bootstrap their startups and they can't get venture capital level, they go to friends, family, and fools. And unfortunately, these are the only people who are likely to believe in newbies and aren't going to do a good job of evaluating the actual business opportunity. And this is a quote from that entrepreneur article. The upshot, however, is that, first of all, there's an awful lot of this kind of funding out there, arguably significantly more than venture capital, and most of these are relatively small and usually in the form of a convertible loan rather than an equity investment. And we'll talk about convertible loans in the final portion of these audio preses. So these are options that are out there, and they're relatively common. It's just important that entrepreneurs recognize some of the challenges. If you borrow money or take an equity investment from friends or family, you're probably going to be bumping into those people for a long time, and you need to recognize what those experiences could be like in the future if you manage to lose all of that money. So there are some best practices that you should consider. First of all, write it all down. Do not simply take money and use it without having some kind of written documentation, even if it's informal, even if it's an email, that states, is this a gift? Is it a loan? Or is it equity? Be very, very clear with people about how risky these investments are. You might think that your idea is spectacular, but until you have lots and lots of paying customers, it's probably very risky. And most new ventures do fail after 5 to 7 years. You should make sure that there's agreement on what your strategy is and what the outcome is. How are they going to get their money back? How are you paying them back for it? Do they get a share of profits? Is there an interest rate? And do prepare yourself for the stress of potentially losing family or friends' money. That is no fun for anyone. Now let's talk about more professional investors, angels and venture capitalists. So these are not the same thing. They both are generally outsiders who agree to invest in your business. Angels are individuals who are investing their own money, their own personal money, usually making the decision entirely themselves. Although many angels are quite sophisticated, generally speaking, many angels make investments based on their emotions or their gut instincts, whether they like you, whether it's an idea they think is interesting. Oversight varies across angel investments. Some angels take a very active role in these kinds of investments. Some simply give you the money and then don't expect to hear from you for a year or two. These kinds of investments tend to be relatively less complicated. There might only be so much documentation, but there still could be dozens of pages or hundreds of pages of documentation required to close one of these investments. A venture capital firm is a managed fund. It is other people's money. That is, a venture capitalist goes out and raises money from wealthy people or corporations, and then it invests that money based on a managed process. A single decision is made to invest the money, usually by a committee at the venture capital firm. Venture capitalists tend to be very active in their oversight. They will usually take a board seat on a startup company, and they will expect regular reports and meetings. And they will build an awful lot of protection into their investment agreement. If you don't make milestones, there may be all sorts of consequences. And these investment agreements tend to get quite complicated. So how should private equity work? Well, your firm needs money to generate value because you've got more R&D to do, or you're going to be growing rapidly and you need cash to fund that growth. So you raise money from the outside investor to make all that work. And then this raises the value of the company and decreases its risk of failure. And if necessary, then you repeat it. So the whole idea of bringing in outside money is not for your sole benefit as a founder. It's to grow the value of the organization. That's the sole purpose of outside capital. So I wanted to provide you with kind of a simple diagram that shows you in a summary form what are sort of good categories for types of stages of funding. This is not definitive. There's no definitive ways to describe each of these stages, but this table kind of provides you with some sense of what it looks like. A pre-seed stage where you're probably raising less than $100,000, maybe only $5,000 or $20,000. What's considered a seed stage where you're probably raising less than $500,000 or $1 million. If you're in California, the seed stage probably goes all the way up to $1 million or more. First stage or Series A funding can often be $500,000 to $2 million, but can be significantly larger than that for some tech ventures. And then second stage or Series B and beyond. And this should give you a sense of where some of that money can come from, sort of the rough venture status, and then the effective cost of capital. That is, what kind of rate of return are the investors actually expecting once they've made this investment? And remember that this is per year, not total, but per year. So 100% rate of return is doubling their money, and that's, if they're expecting that over 4 years, then they're expecting to make 16 times their money back. So this hopefully gives you some sense of what external funding can look like in the forms of debt and equity. Obviously, these are incredibly complicated topics. Your reading that's been provided on raising outside capital gives you lots more detail about all of these topics. You don't need to know everything in that reading, but you certainly should have a good understanding of the core topics there, it's definitely worth your review, both for the purposes of the course, but also and that'll be a valuable resource to you if you actually do end up starting a venture and need to think about external funding.